Hi, Christina Brown here with the Brown team at eXp Realty. A question we get asked all the time: what kind of funds are needed to purchase a home? How much money does it really take? It may not be as much as you think. I have it broken down into the 4 main things you're going to need money for when you purchase a home. The very first thing is, of course, your earnest money. Earnest money is not a legal requirement. However, most sellers are going to require some form or amount of earnest money, because this is the buyer telling the seller, hey seller, I'm serious about purchasing your home, and to show you that I'm serious, or earnest, right, earnest money, I'm going to give you a little bit of money to hold on to. Now, this money is typically between 0.5% and 1% of the purchase price. That's kind of the standard that we see. So if the purchase price is $200,000, you should plan for anywhere from $1,000 to $2,000. And of course, if there are multiple offers, this is a term that you can make more competitive and make your offer stronger by going over that number. But typically 0.5% to 1% is kind of the standard of what a seller would expect to receive for earnest money. Now, to clarify, this earnest money does not go directly to the seller. It is made payable to their title company. Their title company holds these funds in an escrow account waiting for you to close. If you make it all the way to the closing table, then every penny of that is credited back to you at your closing, and you could use it for some of your other expenses that are due at the closing table. If you do not make it to the closing table, it's going to depend on why you did not make it. So what I mean by that is we typically attach contingencies to this earnest money. The most common are inspections, appraisal. Appraisal is 2-part, has to meet value and condition required for the loan. And number 3 is financing. So if the deal falls apart due to one of these reasons, then you, the buyer, are due back your earnest money according to the contract. So that's the first thing you need money for. The second thing, number 2, are your inspections. You want to have money set aside to do inspections. So when they're completed, you pay for and do any and all inspections that you choose. And you'll have 3 options. Number 1, wow, there's a lot wrong with it, I'm going to run away and I want my earnest money back. And then you're due back your earnest money as long as the contract's contingent on that. Number 2, yeah, we found a few things, not too worried about it, I will take it as is. Number 3, I'm going to say probably the most common, except for the last few years when the market's been crazy. We've seen a lot of sellers require it be as is, or a lot of buyers say, hey, I'll do as is to make my offer competitive. So as long as the contract doesn't say as is, then you have a right to renegotiate in some way, shape, or form. This could be in the form of asking for repairs or asking for a price reduction, or a combination of the 2. How much money does it cost for inspections? Well, it's going to depend on what all you do. So you can do the whole house inspection. We recommend you do a termite inspection. Maybe you want to do a radon inspection. Maybe you want to have a structural engineer check out the foundation. Maybe you want to have a sewer scope on the plumbing. Maybe you want to have a specialist come in and check out the fireplace and chimney. Those are all special inspections on top of the general inspection. So those are the ones we see people spend money on. On average, most people spend between $300. I'll say the most common we see people spend up to is probably about $750. So I would plan for maybe up to $750 for inspections. Number 3 are your closing costs. Closing costs, it really depends on the kind of loan. It's going to depend on the purchase price. But a good rule of thumb is to expect your closing costs to be somewhere around 3 to 3.5% of the purchase price. That's not a hard percentage. It doesn't work with every price point, but that is a good general rule of thumb for the average price point that we typically see. So 3 to 3.5%. What in the world is contained in all these closing costs? Closing costs consist of a variety of things. A majority of those funds and fees are going to come from the lender's list. It's going to be any loan costs. They have flood certification fee, they have a credit report fee, the appraisal fee. There's just a whole bunch of stuff. Plus, they will also start what we call your escrow account. This is also part of that closing cost. So what starts your escrows, or what they'll call prepaids in lender terms, is to have a year's worth of homeowner's insurance, because you have to pay for a whole year up front. And then they typically will collect another 3 months. So they are collecting 15 months worth of homeowner's insurance typically up front. That's a huge chunk of of money. And then the other part of closing costs are interest, because you're paying daily interest from the day that you close to the end of the month, because you always pay your mortgage payment the following month. There's just a lot that goes into that from the lender side. The other part are title fees. They're closing fees. They're fees to make sure title's clean and clear, and notarize it and record and all of those things that it takes. And then typically, for those of you that purchase property that is listed in the MLS, a perk you get is the seller pays your buyer's agent commissions. So your fees are typically title and lender fees for the most part. And then if you're a cash buyer, your closing costs are very minimal. I'm going to say pretty much always under $1,000. And then the fourth thing needed when you purchase a home is, of course, your down payment. Down payment varies greatly depending on your loan. You can get a down payment for as little as 0%. So veterans, great to use that VA loan. Great option where you can put no money down. There are also first-time homebuyer programs that help grant you a down payment so that you can also pay no money down. There is also a program called USDA. USDA is if you're looking in rural communities, so it's based on population, but USDA is also a no money down loan. USDA is in areas that are more outlying. So here in our area where we are, it's things like Pleasant Hill, Oak Grove, Odessa, those kinds of areas. So be thinking very rural, Kingsville, Holden, right? So if you're looking to be in those kind of places, great option if you want no money down. There's also something called MHDC, where they help based on if you're a lower income bracket earner for the community. So there are a ton of options. So it could be anywhere from 0% up. It is a misconception that you need 20% down to purchase a home. That is not correct. You can, of course, certainly put down 20%, but it is not required. Conventional even has a great loan program for first-time home buyers only, where you can get as little as a 3% down payment. And then, of course, there's FHA. FHA, you do not have to be a first-time home buyer, and that is a 3.5% down payment. And then conventional, if you're just a standard owner occupant, you can get an interest rate for as little as 5% if you're not a first-time home buyer. So as little as 5%, and the sky's the limit. You can put down as much as you want. These are just minimums to help you. So if you're saving money to purchase, it may not be as much as you think to get into a home. So anyways, I hope that this helps answer those questions. If you have any specific questions we can help with, of course, I would love the opportunity to answer those and be of help to you. So reach out anytime. Have a great day.